Welcome friends and participants to this module on international trade, theory and empirics. We are on the week 11th of this paper and this module. In this 11th week, we have been discussing about foreign exchange market adjustment in the open economy macroeconomic structure. Now, in the last lecture we discussed about price adjustment in the in the fixed and flexible market in exchange rate regime, and we emphasize the role of elasticity of demand and supply, that is important in order to adjust the prices of the exchange rate market. Now, so after discussing this, I think it is important also to note that how stability of our foreign exchange market is. So, since we discuss about changes, we discuss about dynamics. So, stability really matters. Stability of this foreign exchange market is important, and how we can ensure the stability. To discuss this, I will take the help of some cases, evidences I collected through different literature review, and will also present it through the Marshall-Lerner condition. Okay. Now, I just give you certain background arguments behind understanding the fluctuations and the stability of this market. Now, the global political and economic situation actually has been has been becoming complicated, and especially since the financial crisis in the period 2008-9. This is the crisis linked to financial flows for sure, and emerged through the bubble market or the asset market in US. Again it gets passed through, it got passed through to other economies, dependent economies, to many countries, and it was realized and the impact was also observed. Coming to the political and economic black swan, that is the major effect events frequently occurred, such as like Brexit, the United States trade elections, or Sino-India trade war and its frictions, together with unexpected adjustment in the monetary policy of the European and central banks, and also other big economies like India and China, is really creating lots of havoc in the dynamics of foreign exchange market. So, in a nutshell, what we wanted to say, that these are the four important points, like US elections, the Brexit or Britain's exit from the European Union, then Sino-Indian trade, US-India war, US-China, that is US-China trade war, etc., has actually created difficulties. Hence, the exchange rate volatility cases are rising. Okay. So, just rising volatility may actually create problems in terms of policy for monetary adjustment or monetary policy adjustment. So, the potential economic and financial uncertainties have significantly increased. Okay. The exchange rate instability usually has a negative impact on the economy, and also transfers external risks that pose a considerable threat to the financial security and the stability of a country. It is not just the financial market that is unstable, or the instability in that particular market is not only in financial sector, but also it gets transmitted to the stability of the country. Okay. I mean transmitted to other sectors of the country. Therefore, it is a matter of concern, and we need to understand the stability of our foreign exchange market. Now, what do you mean by unstable foreign exchange market? That has to be clarified. The concept has to be very well understood. When a disturbance from equilibrium pushes the exchange rate further away from equilibrium, is called is called unstable market. Any kind of disturbance deviates from the equilibrium level and further pushes away from that equilibrium level is called unstable foreign exchange market. Okay, so and that might be due to supply curve if is negatively sloped and more elastic than demand curve of foreign exchange, or the flexible exchange system increases a balance of payment disequilibrium rather than reduces. So, in this case so to say that what we say if there are some equilibrium point, if the if there are any forms of entropy in the market, that would actually lead to further disturbances within the market is called unstable foreign exchange market, and that is caused by supply curve which is negatively sloped and but it is more elastic. Okay. And especially in the foreign exchange flexible foreign exchange system, the gap increases further rather than reducing or settling at the equilibrium level. Now, in case of stable foreign exchange market, when disturbance from the equilibrium actually gives rise to automatic adjustment and the forces are inward to take back the equilibrium conditions to its equilibrium point again, is called stable foreign exchange market. Now, in that case supply curve is positively sloped, or if any negatively sloped, but it is less elastic than that of the demand curve of the foreign exchange market. So, this is the condition we are going to validate in our discussion, and we will understand how it is correct. Through our diagram only we can understand. Now, coming to the discussion and through the diagram, I think it is here in front of you. Now, in this diagram it is you can refer to Salvator book on international economics 10th edition I have referred. So, it suggests that the demand and supply of billion euro by America or by US market is and three different type of diagram we are presenting. In the first diagram we are presenting the stable market, and the second also is a stable market, stable foreign exchange market, but third one is unstable. This is what we will emphasize in a short while. Now, I will just draw and and we will discuss about this in a short while. Like suppose the demand, and it is very simple to understand, it is a demand curve and it is supply of euro. Now, both are elastic in our assumption, or demand curve is downward sloping and supply curve is upward sloping, and the slope of the supply curve is less elastic than that of the is less the elasticity of demand for supply is less than that of the elasticity demand of demand. Okay. So, in this case let me just first explain this. Equilibrium point is identified at E, okay, at point E on the first diagram. Okay. This is first, this is second, and this is third. All right. On the first one, if the foreign exchange at the equilibrium rate, it is settled at 1.20. Okay. Now, suppose we say that the country is appreciating its currency, appreciating its currency, that is dollar to euro, or the US has taken a decision to go for appreciation. Now, the value is 1. Okay. If it is 1, what really happened when the dollar value is appreciated? Okay. There is more demand for imports, and there accordingly more demand for euro. So, the demand actually exceeds much higher than that of supply. All right. So, in this diagram it is 8 to 12. So, 4 billion euro, 4 billion euro, okay, euro 4 billion is over demanded in US market. Now, that has negative implications on the balance of payment of US. All right. So, when the balance of payment is in trouble and deficit, it has again an impact on their decision to go for depreciation or devaluation of the foreign currency. If it is completely market based, since the rate of I mean the euro is over demanded, the rate is expected to be rising. So, so in the flexible exchange rate system, the unit rate of euro is as per the market or market determined rate, it will automatically have an upward movement and there will be depreciation, hence there will be a depreciation of dollar. So, accordingly we are having a inward movement towards the equilibrium again. Similarly, if there is depreciation from the beginning, there will be again inward movement towards the equilibrium point. So, hence the equilibrium will be settled at point E. Okay. Now, coming to another stable condition and to emphasize that the supply curve is also downward sloping. Here as against this in the first diagram, on the first part of the first diagram, we said that supply curve is upward sloping. Now, we are saying supply curve is downward sloping and demand curve is downward sloping. Okay. So, let me just mention, you might not focus, both demand and supply are demand curve and supply for foreign exchange or that to euro are downward sloping. Okay. Now, if they are downward sloping, then what is going to happen, whether we can still reach to the stable equilibrium condition or not, let us have a look. Now, initial equilibrium condition occurs at E, okay, or otherwise if you start with 1, suppose we start with 1 as the exchange rate between dollar and euro. Now, at 1 given this diagram, when the elasticity of demand is lesser than that of absolute value of the elasticity of demand is lesser, elasticity of supply is lesser, the elasticity of supply, absolute value of elasticity of supply per euro is less than that of demand. Elasticity of supply of euro is less than that of elasticity, the absolute value, elasticity of demand for euro and its absolute value. If this is the condition, then what is going to happen at 1 exchange rate, still there is over demand, roughly around so roughly around 1.5 billion euro. Okay. So, since there is over demand of euro, there will be upward movement of the exchange rate. So, the value of dollar depreciates. Similarly, if you start from 1.40 or a higher point, there will be again backward movement or inward movement towards the equilibrium point. Hence, there will be a stability in the foreign exchange market. So, what is the condition then? The elasticity of value, elasticity of supply and its absolute value of elasticity of supply is lesser than that of elasticity of demand and its absolute value. In this case also the absolute value of elasticity of demand is greater than that of absolute value of elasticity of supply. Okay. Even if since it is rising, we do not have any problem. If it is falling, I mean if it is either the supply curve is upward sloping, it is not going to create any problem. If elasticity of supply is downward sloping, then this condition must hold. Okay. Now, coming to the instability part, we will simply reverse it. Okay. How we will reverse it? Elasticity of supply for euro is greater than the absolute value of elasticity of supply of euro is greater than that of elasticity of demand for euro and its absolute value. If this is the case, now what really happens if you start with 1 again at 1 exchange rate, there is oversupply, okay, and demand is this much. supply is higher. So, 1.5 euro is oversupplied or over reserves are already available in US. Okay. Since there is oversupply of euro, the price is expected to be falling again. Okay. So, that means there is comparatively over demand of dollar, therefore, dollar may be appreciated further. So, the equilibrium point might I mean the new prices might be deviating from this point. Okay. So, there might be deviation, further deviation. So, there might be further deviation, and there is no question of inward movement. Similarly, if you check with 1.40 as a starting point, there will be again forward movements, and it's against the equilibrium condition. So, therefore, equilibrium condition that is at 1.20 or anywhere is not going to be met. Okay. So, it is called an unstable market. All right. Now, I think I have already clarified it. When this condition holds, equilibrium exists and it is called stable. When this condition holds, it's going to be an unstable market. Okay. Now, on the basis of this pretext, Marshall-Lerner condition is defined. Now, what is that Marshall-Lerner condition? It is related to elastic demand approach for sure. Now, it says that the elastic demand approach is based on two direct effects of devaluation or depreciation of the balance of current account, that is namely price and volume effect, either price effect or volume effect. As the domestic currency devaluates in fixed exchange rate or depreciates in floating exchange rate against the foreign currency, prices of the domestically produced goods becomes relatively cheaper for both domestic residents and foreigners. Alongside, the imported goods become become relatively more expensive. Hence, it leads to the net effect of devaluation or depreciation of the currency on the trade balance depends on which of the two effects is dominating or dominates over other. Okay. The elasticity approach becomes popular with the given contributions by Marshall and Lerner. Marshall in 1923, way back in 1923 and 44, this condition has already been populated. Now, after saying so, we are now summing of the Marshall-Lerner condition, that it says that some of the price elasticities of demand for imports and demand for exports is indicating degree of foreign exchange market stability. So, exports indicate so some of the this indicates is correct. Okay, indicates degree of foreign exchange market stability. So, some of those elasticity is important in its absolute term. Okay. Now, what is the condition then? If the sum of those elasticities or the absolute value of those elasticities is greater than 1, then the market is stable, or no, foreign exchange market is stable. That means, devaluation required to correct the BOP deficit. When it is less than 1, the revaluation required to correct the BOP deficit, because it is going to be unstable. When it is on less than 1, the market is unstable. When it is greater than 1, the market is stable and devaluation works, whereas revaluation is applied in other context. So, you need to take a note of this for quiz questions. Okay. Now, if it is equal to 1, then change in the foreign exchange rate leaves balance of payment unchanged. Any kind of change will actually take its back to the foreign exchange equilibrium condition. All right. Now, it simply states that real devaluation or depreciation of domestic currency will improve the trade balance if the sum of the elasticities which are in absolute values of the demand for imports and exports is greater than unity. This is what we have already said. Seeking an answer to the most important question, whether a flexible exchange rate will always lead to balance in the current account, or a fixed exchange rate regime, whether devaluation is a solution to the balance of payments problem, or the Marshall-Lerner condition explain this carefully through its full story. Okay. So, these are the aspects we are discussing. Empirical testing of the Marshall-Lerner equation has a rich heritage on the evidence of rich heritage, and the evidence in favor of the condition is actually mixed. So, there are mixed responses so far as Marshall-Lerner condition gets fulfilled in different countries or not. Some studies like Marwa and Klein in 1996, Bahmani, Uskui and Bulhasani in 2008, Bahmani, Uskui and Kotan 2009, and Bahmani, Uskui and Chima 2009 reported some mixed results in the application of Marshall-Lerner condition. So, some other paper found that Marshall-Lerner conditions holds in the long run. Okay. Paper like Onapova observed that it is applicable in long run with a varying degree of J curve effect in the short run. Okay. So, with J curve effect we already discussed. Now, I think couple of slides are left. Studies in the Indian context are also found to be inconclusive. One of the paper I have referred, as they showed mixed result. Then this author found that deteriorating trade balance with devaluation in both short run and long run is important. Most of the studies on this condition, that is Marshall-Lerner condition, use the balance of trade as the difference between exports and imports. But in recent years it has been observed that working with the ratio of exports to imports or vice versa is more convenient than that of the total amount of exports and imports. So, the ratio is more important. Okay. So, empirical evidence suggests that and I have also referred to the Salvatore book once again on the real world evidences, that it suggests that empirical evidences suggest that Marshall-Lerner condition holds for the foreign exchange market, indicating a stable market. Okay. Quantity response to price change must be measured over longer period for accurate elasticity measures. So, these are also observed some identification made that there are automatic change in the supply of exports. If we count the export market of US, then there will be new equilibrium point. Okay. If there are any adjustment, it will automatically settle at a new equilibrium point, but there will be equilibrium for sure. Okay. Now, elasticity in the real world is mentioned by Salvatore by referring these two authors. They identify that 5 possible lags in quantity responses to price changes in international trade. There are possible lags they have identified. There are 5 lags. One is recognition lag before price change becomes evident. Is there any lag is there between quantity, demand and supply. Then decision lag to take advantage of price changes, then delivery lag, then replacement lag, then production lag to change output mix resulting from price changes. Now, some recent evidences, I am referring to the journal article. It says that especially for Chinese yuan devaluation context, recently yuan devaluation has threatened global financial stability and has invited unwarranted currency war. Indo-China, Indian context with regard to China, Indo-China bilateral trade, which was as low as $2.9 US billion in 2000, reached to US that is $72.3 US billion in 2014, making China India's largest goods trading partner. Okay. So we have collected till 2014 figure. India has a hoping trade deficit with China that is of 48.5 US billion in financial year 2015 on account of rising imports and dismal exports. Alright. So, trade deficit is majorly responsible due to imports from China. The recent devaluation of the yuan around 4% in 2 days in August 2015 would make or made Chinese exports look more competitive than that of India. Okay. And this is in turn in turn would have a negative impact on Indian exports with that devaluation of the yuan. Okay. Now, so these are some recent evidences to refer, so that the author has calculated that there are still mixed responses so far as the stability is concerned. Yes, there are further adjustment, but the author found that the Marshall-Lerner condition again is valid to certain extent and certain time period. It is not going to be generalized in all the context. If the conditions holds correctly, then it gets fulfilled. And its implications are valid to define a stable market. With this, I think I have concluded. I have already finished the context of stability in the foreign exchange market. So, I look forward to your participation in other lectures, and with this I should stop here. Thank you.